Hey, what's up, my friend? So, in today's episode, right, I want to talk about why you lose money trading chart patterns. So, I'm sure you probably, know stuff like head and shoulders pattern, the bull flag pattern, diamond pattern, triple top, double bottom, etc. And you memorize all these patterns, what it means. But still, right, you lose money, right, when you trade these patterns. Why is that so? So, there are a few reasons for it, and I want to break it down, right, in today's episode. Number one, you fail to take into consideration, right, the context of the markets. So what do I mean by this? So imagine this, right? You spot a bull flag pattern. Okay, price, rallies higher, and it makes a potential bull flag pattern on the, retracement very weak, right? Signaling that, the price could break out higher. But here's the thing, right? The overall market is in a downtrend. So imagine this, right? A bull flag pattern that is formed within an existing downtrend. What are the odds of that bull flag pattern working out? On the other hand, let's say another scenario. This time around, the market breaks out of the range to all-time highs, and a bull flag pattern is formed. Imagine now this scenario: the price is at all-time highs. It makes a potential bull flag pattern. What are the odds now of this particular setup working out? So can you see what I mean by context of the markets? I give you two examples. One is when the market is in a long-term downtrend and you're looking to buy the bull flag pattern. Two is when the market breaks out to all-time highs and it forms a potential bull flag pattern. See the difference between the context of the markets that you're trading? This is important, right? If you take into consideration the context of the markets, you'll find that your chart pattern trading, right, will improve. So that's the first thing. Second thing, you neglect, right, the significance of the chart pattern. What do I mean by this? So let's say the market is in a long-term uptrend over the last 200 candles. The market, right, has been overall going up steadily. And right now, right, the market actually formed a head and shoulders pattern. And this head and shoulders pattern, right, only took like 20 candles to form. Okay, so imagine this, right? A head and shoulders pattern is formed, right, on the basis of 20 candles. And this, right, is in a long-term uptrend, this market condition. And this long-term uptrend, right, is defined, right, by 200 candles. Right, meaning the price goes higher highs and higher lows over a series of 200 candles. And then it forms a head and shoulders pattern, right, that is made up of 20 candles. Now ask yourself, right, what is the significance of this head and shoulders pattern? What are the odds of this head and shoulders pattern winning, right, the long-term trend? 200 candles, right, of an overall uptrend versus a 20 candle head and shoulders pattern. I mean, logic would tell you that the market, right, is likely to continue higher because this head and shoulders pattern is pretty darn insignificant. It's only 20 candles versus, right, a 200 candle uptrend. Do you see my point? Now let's change this scenario a little bit. Now, what if, again, same thing, right? The uptrend is made up of 200 candles, but this time around the head and shoulders pattern is made up of 300 candles. So you can imagine that this time around the head and shoulders is much bigger because it takes 300 candles to form. Now, do you see the significance of this? Because when you have a head and shoulders pattern that is made up of 300 candles, then the dynamics have changed drastically, right? Because now the neckline of the head and shoulders pattern, or otherwise known as a support, right, it will be obvious. It will capture the attention of a lot of traders. And when that level becomes significant, right, even on the higher time frame traders, right, if it breaks, right, that is now more significant because it breaks a key area of support that has been defined over 300 candles. And when it breaks, right, that becomes a more significant chart pattern compared to a head and shoulders pattern, which is formed over 20 candles. So pay attention to the significance of the chart pattern as well, right? If it forms, right, after 5 or 10 candles, it won't be as significant compared to a chart pattern that is formed over, 100, 200 candles. The third thing, right, you neglect the nuance of the chart pattern. So what do I mean by the nuance of the chart pattern? So again, let's talk about head and shoulders pattern since this is like the most popular one out there. So head and shoulders pattern, you have the left shoulder, you have the head, which is the highest peak of all, and followed by the right shoulder. And if you think about this, right, the classical head and shoulders pattern, right, where the price drops from the right shoulder to the neckline, it will make quite a distance, right? The move is quite a distance. And if you think about this, the move has made quite a distance to the neckline. Let's say the neckline is here, then this right shoulder, right, it dropped down to this neckline over here. It's quite a distance already. And there will be traders who look at this, right, and say this neckline is an area of support and they're looking to buy. And the price reverse from the neckline and continue higher. Can you see where I'm coming from? So this is a very typical head and shoulders pattern, right? The right shoulder drops to the neckline and the price reverses higher because it came into an area of support. But what if, right, now this head and shoulders pattern, right, it formed in a slightly different manner. For the right shoulder, instead of dropping straight into the neckline, what it does is that it drops into the neckline it starts to consolidate at a neckline, maybe forming a tight consolidation. Now the message right by the market has changed because it's telling you that it has reached an area of support, otherwise known as the neckline, but it failed to rally. This tells you that two things. Number one, there is a lack of buying pressure. Or number two, selling pressure is coming in to hold the price down lower. And if the neckline breaks, okay, there will be a flood of order, right? Stop loss order that's being triggered right there would add fuel to the selling pressure, and that's where the likelihood of a reversal is much higher. So can you see again the two scenarios? A normal head and shoulders pattern, right? One, the right shoulder just simply dropped quickly with a huge momentum into a neckline, and the second one, which the price approaches the neckline, starts to consolidate for a while before it breaks down. So these are the nuances, right, to chart patterns, and you have to understand these different nuances. You can't just take the classical chart patterns shown by the textbook or courses and then memorize it and then look to trade it. No, you got to understand all these different variation and nuances where traders might get trapped, where would their stop loss get triggered and stuff like that. Okay, so chart patterns is more than just memorizing all this. It's not an exam. This is the real world of trading. And the fourth thing I want to share with you is this: is that traders think that chart patterns can predict the future. Come on, man. I mean, I don't blame you because that's what I thought as well. You see a triple top. Oh man, the market is going to reverse lower. Oh, double bottom is the recovery is in place, right? Time to buy. No, it doesn't work that way, right? Chart patterns, they're just simply tools, right, to help you gauge buying and selling pressure in the market. Right? Who has the upper hand, the buyers or the sellers? And that's pretty much it, right? And chart patterns help you define levels, boundaries on where you can look to enter a trade and set your stop loss. That's really what chart pattern is about, right? Identifying the buying and selling pressure, and then finding a useful price point levels based on chart pattern to set your entries and stop loss, and even manage your trades if you want to. So that's really what chart patterns is used for. Okay, not trying to predict what the markets will do. So when you know this, right, when you know that there is always a probability of a loss, even though the head and shoulders pattern may look extremely beautiful, all the stars are aligned, there's always still a probability of a loss. So you still must take into account your risk management. Okay, so I hope these pointers help, right? If you're struggling with chart patterns, right, chances are it's because of one of these reasons that I just pointed out. So with that said, I have come towards the end of today's episode. If you've enjoyed it, give me a thumbs up, subscribe to the channel, and I will talk to you soon.